One last slide, and then I'll open this up to questions. This is something that's just an important thing to know. If you hear people talking about currency trading, the first thing is there are different pairs, and the most common pairs are going to be euro dollar, pound dollar. These are common pairs, and there's a few others that you can see there. And then the base currency is always first, and the quote currency is second. So if we look here at this particular slide, we see that the smaller the spread, the more liquid the currency. Now, what that means is if you're trading a major currency pair like the ones there, it will have a smaller spread. Whereas if you are trading an exotic pair where it's something less commonly traded, it's going to have a bigger spread, a wider spread. There's also a term called a point. It's also called a pip, and this actually means the fourth unit after the decimal point. So we go here 1, 2, 3, 4. That's what we're talking about with a point or a pip. And it's the smallest unit of an exchange rate. And then you look at a spread, which is showing, okay, the selling price, or also called the bid, is 1.3000. And the buying price, also called the ask, is 1.3001. So that's just kind of an important thing to know. That is the last slide. So at this point, I'm going to open it up to questions, and I will be happy to answer any questions that anyone has. So are there any questions?
So I've got one question. Just in general, do you think it makes sense to get into currency trading without too much money? Because I think how I see it, you need quite a large sum of money to actually make an impact if you're gonna hold it longer, because short-term forex trading doesn't really make sense. And I think for the long term, you probably need more capital. Is that right? Or
That's a great question, Chris. And I'm so glad you asked it, because I'm going to give you a little inside tip that most people in the world don't know. This is something that is a great way. It's what I call a backdoor into currency trading. Mm-hmm. So, yeah, I mean, if you're dealing with a small amount of capital, currency trading, the first mistake that people make when they have a small amount of capital is they start thinking, I just want to double this. I just want it to go up a lot in value. And they start getting aggressive with their leverage. And what that means is you'll see people that are new at currency trading where they will go crazy on leverage. They'll do 1 to 50 leverage. They'll do 1 to 100 leverage. Now, that is a recipe for disaster. That's a recipe for losing your money. And that is way too much leverage to put on a currency trade unless you really know what you're doing. And if you think you really know what you're doing, you should think long and hard before you take on that amount of leverage. Now, here is the golden nugget on how to trade currency, how to get leverage off of it. And this is something that I'm not aware of anyone else that really explains this, but basically you can accomplish the same thing in an easy way. Let's imagine you have a pair that you want to trade. Let's take the example of the US dollar and the British pound. Okay. Mm-hmm. What you can do is right now the US dollar is strong. Rather than going and putting that money into an online Forex account and just playing around, clicking buttons, looking at charts, what you can do that's a smarter way is you can get real estate in the United Kingdom, where you could buy real estate with US dollars in the United Kingdom. Now, yes, you do have to exchange the currency to be able to, but it's a one-time exchange. It's very inexpensive, the spread to change. And now you can obtain leverage, because what you can do, you're not going to get as much leverage as if you're playing around with 1 to 50 or 1 to 100, but you're also not going to lose all of your money. So that's a big benefit if you don't lose all of your money. And you don't have to even guess in a short term. You can buy real estate in that country. And another thing you can do is, let's imagine that you have a lot of free and clear real estate. That means with no mortgage. Imagine you have a portfolio that's worth, just to make it simple, let's say you've got 5 real estate assets, and let's imagine that they have a value of 200,000 euros each asset. I'm just making a number up. So you've got €1 million in real estate. You've got 5 assets, and you're looking at the exchange rate between 2 countries, and you determine that, you know what, I think that I need to get my currency, which is an appreciated currency. Your country's currency has appreciated, or the country where you're holding the real estate has appreciated. You can do a cash out refinance. It's not a taxable event if it's a cash out refinance. And with that, you can go and say, look, let me borrow 70% of €1 million. So you get 700,000 euros. Then you can take that 700,000 euros and you can go over to the country where now you've got this currency that has a lot more buying power, and you can purchase their real estate. You can take advantage of the fact that your currency has more buying power. So you exchange the currency from, say, euros. Maybe you exchange the currency to another currency, like, just hypothetically, you exchange it to, say, Ukrainian hryvnia. Or if you're not wanting to take those kind of risks, you exchange it to maybe British pounds. And now you can you've got 700,000, and you could use that with leverage, but a reasonable amount of leverage. You're not going to have the sort of 1 to 50 or 1 to 100 leverage, where now you could go into that other country and you could say, okay, I want to put 20% down on some assets. I have a total of 700,000 euros. I can put 20% down. You buy several assets. Now you can obtain leverage on that, where you are able to actually acquire 1.4 million worth of assets in that other country, denominated in that other country's currency. And you have a nice advantage, because what's great about it is, let's say that currency just goes off a cliff. Imagine it turns into a situation where it's some disaster, where the currency really goes down in value. Every year, every 6 months, depending on what your agreement is with your tenants, you can just have your property manager talk to your tenants and say, you know what, the rent here, it used to be rent of, for example, it used to be rent of £1,000, but now the rent has to increase to £1,300. Or if you're in Ukraine, it used to be rent of, say, 15,000 hryvnia, but now the rent has to be increased to 25,000 hryvnia. I think you are a great tenant, but I can't do anything about it. Look at the inflation rate. I have to do it. I don't have any choice. And you'll be able to adjust. So that's a big advantage. You have a mechanism with real estate where you can adjust. So that's something that you can basically do currency trading with real estate. You're using a bit less leverage than the ones that like to get all amped up, and I'm going to go do a 1 to 50 or 1 to 100 trade. But those guys just fall by the wayside. They just are getting wasted. And for every one of them that pops up explaining, I'm a genius and I know how to do this, there are bodies scattered all around of all of the ones that took on that 1 to 50 or 1 to 100 leverage, but they don't get on YouTube and sell courses. They don't explain all that stuff to you. You only see the survivor, the quote survivorship bias. So it's something that is real important, and it's a good strategy. I encourage you to think about that. I hope that makes sense. Did that answer your question?
Yeah, no, definitely. Thanks for the answer that much in detail.